This year saw a lot of tax changes. The big beautiful bill. Some people call it the big bad beautiful bill. There's not a political commentary. It's a commentary on the tax law and what we foresee coming forward. The emphasis that Congress gave us is this is for the middle class. And I think the middle class is based on the Midwest and not New York cost of living and incomes. But let's start out with overtime. No tax on overtime. First of all, not exactly true. There is Social Security tax on overtime still. So what is the no tax provision? We have time and a half in New York for overtime for salaried hourly workers, not for managers, not for salaried folks, not for officers. And all that will come under this new rule is the half. Okay. In the materials, there's an example that Scott put in. So, if you're getting $60 as an hourly worker, and you get time and a half, it's $90. $30 is what's subject to the no tax on overtime provision. And again, just the income tax, not the Social Security tax. We are still waiting for final word from New York as to whether or not they're going to recognize this. For those of us who recall what happened during COVID with the unemployment, New York decoupled from the feds on both unemployment exclusions and charitable deductions. They don't always match up. So what happens to the employers? What happens to the employees? And what if you're not an employee? Well, you have to be an employee to get the overtime because you're subject to the labor. This comes under labor law. So that's where time and a half comes from. Also negotiated contracts with union workers.
Also, just to just jump in, it also is only for hourly wage workers. If you are a salary worker and you work overtime, there is no deduction at all for you. You are not part of the new law. You are paying on the full amount of overtime as regular income tax, no matter what time and a half or whatever else there is. This is only on hourly workers.
And also, for some people where they get compensatory time for the so-called overtime they put in, it will not apply to that either. Okay. Who knows what is going to be the actual effect of this? First of all, it's limited to $12,000 per person. In a two-earner household, it's a $25,000 maximum. The way the draft forms are set up, which we weren't able to get a good copy of yet, it seems that if you're married and one of you has overtime and the other does not, you could probably still qualify under the $25,000 total exclusion this year. Why? It's not required to be put on W-2s at this point. It will be for 26. This law was enacted, as you know, last spring, and it's going to take time for everybody to get into a set of regulations and compliance. One of the things we find in tax law is that Congress passes a bill and the president signs it very often without input from the Internal Revenue Service and their professionals. And since there's a 3-year audit window for the IRS, they don't have to come up with the regs right away. For those of us who were around for the 1986 tax changes, which were huge, the IRS didn't issue regulations for close to 2.5 years in some of the areas. Okay. This, by the way, is not a permanent exclusion. It only goes through 28. Congress and the president both stated they want the next president to be able to decide whether or not to continue this or not. Doesn't apply to us as attorneys, nor does most of the changes that could potentially be beneficial. And now let's Scott move on to the next section.
Part of tax law, as exciting, of course, as it can be, is, in theory, we're talking about what's the public policy benefit or detraction from this. And so while we could pretty easily understand the rules here on time and a half and just a half and the income limitations. We also have to look on what are the consequences, or what could the consequences be for public policy. If you are able to take home more money than you used to in overtime, this would incentivize individuals to work more overtime, which can be fine, but what will that do? That one public policy unintended consequence potentially is that you'll need to hire less workers. It can be damaging to the job pool because if you have more people working more because they get to take home more, then that employer is going to need less individuals working for them. Another potential public policy issue is just family time, right? We talk as attorneys, we talk work-life balance. There's full CLEs on work-life balance and how to attain those. Um, my dad is smirking because this is a work-life balance is something that we talk about all the time. And if we are now incentivizing people to work more, at least hourly workers to work more, it may have potential implications in their lives as they operate, with less sleep or less family time or whatever the case might be. Um, and as he mentioned, this does expire at the end of 2028. Like most tax laws, I find that anything that saves people money that may not be a great idea in the long run is always going to expire at the end of a term so that if they don't renew it, it's unpopular for the next president not to renew it, and not as much so that the next person can have free reign to decide on their own.
Just as a factor from an employer perspective, one of my clients has a approximately 60 employee business in New York City, and he was having a hard time getting his workers to work overtime on projects when he needed them. And this exclusion encouraged a number of them to now volunteer for overtime, at least up to the 12.5 or 25,000 limit. How will it work out in the long run? We don't know. It's extra bookkeeping, certainly, for the employer going forward. And we'll see. We'll see. Okay.
We also mentioned the inequities between the hourly worker and the salaried worker. And so I put the example in here, but I do want to just kind of talk it through quickly. So um, if you have a single filer who makes $60,000 as an hourly worker and they earn $10,000 of overtime, that worker on the federal level, at least, right? We don't know what New York is going to do. They're only going to be paying tax on $60,000 of income. If that same person was salaried, making 60 and earning $10,000 of overtime, and when I say overtime income, I mean just the half, that person's going to be paying on 70,000. So you have somebody making the same amount of money, living in the same area, potentially working in the same or similar jobs, just in a different contract, and person two is paying, a couple thousand. Let's assume that they're in the 12% marginal bracket. They're going to be paying an extra $1,200 in taxes on the same amount of income. So that's a clear inequity. There's benefits, of course, to a salaried worker, oftentimes in the benefits. So we'll see if this kind of levels off and makes sense for everybody, or if it really just becomes inequitable and you have more people sacrificing potential benefits so that they can be hourly workers. One of the other big pitches with this bill before it was signed into law that came during the campaign and even before the campaign was it was overtime, no tax on overtime, and no tax on tips. Just like the overtime laws and just like almost everything in the tax law, this is not an absolute no tax on tips. But it is more favorable, in our opinion, than the rules on overtime. So first, instead of the $12,500 maximum on overtime, you have $25,000 on tips that are tax exempt, that are income tax exempt per year. This does have a phase out starting at $150,000. Now, the assumption is that many people who are earning that money are not earning a lot of tips, but you have high-end restaurant workers who could certainly be making this, other fields. The other issue, because you may think to yourself, hey, I've gotten a tip as an attorney for doing a good job or whatever the case might be. In order to be eligible, the tip has to be reported to the employer and by the employer. So, for somebody who's getting a tip and wants to do the right thing and report it on their taxes, if that tip is not reported to and by the employer, then it doesn't fall under this new provision. In order for it to be a tip, it also has to be voluntary. So the example we gave here, and of course there's no guidance yet, is what about a party of six goes to a restaurant and automatically there's a service charge, a service fee instead of a tip because they don't want to short the waiter. So that restaurant has a policy. It's unknown right now if that service charge would fall under this or not. So there's a chance that restaurants may get rid of that rule if the waiters would rather there be no service charge so that they can get a tip so that they can have less taxable income. And just like the amount of paperwork that will be added on the overtime rules, there's going to be more paperwork and more accounting work to be done for the tips on the employer side. So we have included an exhibit with the occupations that customarily receive tips. The list is not exclusive. I mean, it's not restricted to only these jobs, but if you are preparing taxes or if you're going through things, these are maybe the jobs to be aware of. What we have a lot of clients and a lot of different kind of work. I don't think we've ever had a casino dealer. So I really don't know right now what is reported on those. Everybody rings the bell. You tip your blackjack dealer, they ring the bell. I don't know what goes on their W-2, but this, in order to be tax-free or income tax-free, this would have to start going on the bill. And of course, this also expires in the end of 2028 to make it the next person's problem. Because again, this I think will be popular, at least the idea of it. Right? What we often see is people don't really understand the tax law. They like the idea. They hear there's no tax on tips. They like the way that sounds, whether or not they understand the actual law that goes along with it.
One of the things also historically, tips were examined by the IRS. There is a box on the W-2 for employees that show what Social Security tips are. Well, let's assume that the cash went in people's pockets and those tips came from the credit card charges and the like. And it was supposed to actually equal a certain percentage, close to 17%. There was a Form 4137, it still exists, where employees are supposed to report their tips. And when the IRS has had its audit projects for tips, which they have done every few years, especially in Manhattan, they did try and enforce that 17%. So if you have a tip worker who's not getting that, or they, work in a restaurant that does not tip high, they should keep a tip book, because we're going to have this allocated tips may come back again. A further point with this is, what about self-employed people who get tips? People rent chairs in a hair salon or a barber shop. I have a daughter, he has a sister, same person, who is a wedding planner, an event planner. She gets tipped occasionally. She will be able to use this if her income falls within the limits. So even though she's an independent contractor, the tips will be subject to this. I have seen people over the years, by the way, in other professions where you would think there's no tips, but they are. There's a customary gratuity. And there's self-employed people. We're excluded from everything. Attorneys never get a break. And they will be able to address this on a separate form. So you might want to advise your self-employed clients that they need to keep a record of this and they're eligible for it. If they're S-corps, where they're supposed to pay themselves salary, and they may get tips as well, they may get gratuities, you want to let them know that they need to track this going forward. So that's what we have with this. By the way, the occupation code is sort of interesting. It doesn't have everything. We have installers. Somebody just put screens in my lanai here. I'm in Florida at the moment. And we would give them a gratuity for that. And it would be cash. Doesn't hurt us. We can't write it off anyway, but whether they choose to report it or not, they're still going to end up owing the Social Security. One of the big problems with tipped employees is if you're like at Nobu or a high-end restaurant. I had people who were waiters at Sparks years ago, And in the late 80s, early 90s, they were making $85,000 or $90,000 a year, most of which was tips. Their withholding was next to nothing because back then cash tips were king. It wasn't all credit cards. And they would have next to no withholding with a big tax bill at the end of the year. Still, it's good to have tax excludable income, but there could be other consequences. And that's where we will go with tips.
Just
to ensure prompt service, hopefully.
Yeah, just one more note on the tips is because if you're a self-employed worker, my sister, for example, who's reporting all of her income, including the tips, she's also self-reporting the tip amount. And so while that will save on income tax and there is no exemption from self-employment tax, I suspect without any guidance, because there's never guidance on this, that there may be an increase in audit for self-employed people who report tips because it is totally self-reported, and that may cause an issue. So that's also, we're talking about bookkeeping and account keeping, that also may add a burden to self-employed people in the professions that regularly earn and report tips.
By the way, the other unintended consequence of this, especially if it's audited and reviewed by the IRS, I don't know how many recall there were two clubs in Manhattan called the Tunnel and Limelight in the Chelsea area. Big bars, lots of action. They got audited by the IRS, as did the employees. And the employer, for salaried employees, has to pay Social Security on those tips as well. They pay half, the employee pays half. And they had to close after that audit. It was huge. People were making hundreds and hundreds of dollars in tips at night. I had one of the bartenders, and her salary, when the IRS reconstructed it, they wanted to bill her for $70,000 in 1989, and she had really $30,000 with her tips because she kept a tip book. She had a good tax attorney who told her what to do. But yeah, there could be other unintended consequences on the employer's side.
We actually got a question that I think is interesting, and I don't know the answer to it, so I don't know if you can see that. It says, are title closer appearance or pickup fees tips? So a pickup fee, I think, is not a tip. I think definitionally it's a service that is, it's often listed on the title bill, on the right side of the bill there. Appearance fees, I think we call them, I call them tips. I would think that person, that individual would, if they're reporting the tip, which they probably are because it's coming in as a check, nobody's getting cash tips, or there are very few getting cash tips at closing. I would think that would be includable as a tip. What are your thoughts on title closers?
I would go for it. If I was advising somebody who was a closer, and I do have one client who's a closer, I had already suggested to her and her husband, who had a question about this, to track it. We'll take it and see what happens. Because, again, the regs are not out yet.
Okay. And we're talking serious money, because if you're getting, let's say you're getting $250 at closing, you do 100 closing, it's $25,000 in tips. It's potentially, you could be potentially maxing out the amount of tip income in that way. And again, if you're marrying, if you're filing with your spouse and your marginal rate is 24, 28%, 32, whatever it is, we're talking, serious savings if you're saving on that money, $8,000, $10,000, depending on the rest of your income. So absolutely, I agree. It should, you got to try it. If you can't win if you don't play, as we say.
That's it. Moving on, for those of you from my generation who remember the 80s and the big change in tax law, up until 1986, you could write off as an itemized deduction your interest on credit cards and other personal loans, including auto loans. This phased out between 86 and 90, and it went away at that point. Now, auto loans, I guess to stimulate the American motor car industry, are back. It is a Schedule A itemized deduction. You can also take it as an adjustment to income. It doesn't have to be itemized. And we have some requirements. The loan must have been taken after January 1st. It has to be a personal vehicle. If it's a business vehicle, you can write off the interest anyway against your business if the business owns it. It has to be finally assembled in the U.S. Well, the VIN number will be the indicator. I don't know, Henry. I don't know my VIN number. I recently got a new vehicle, and apparently, looking at this provision, yes, my car was finally assembled in the U.S. The maximum deduction is $10,000 in interest annually. If you remember back in the late 70s when the interest rates were 17 and 18%, this was substantial. Phases out, 100,000 for single people, 200,000 for joint filers. Again, another expiration in 2028. You may see some indications where many car dealers, one of their big things is zero interest for 5 years. We may see that change because this is now going to be deductible. And if you're making $100,000, you're going to have some income in the 22% bracket. Not a lot, just a little, but 22%. Again, nice little difference. Whether New York State will pick this up, we don't know yet. We know in Jersey it's not going to matter because Jersey doesn't give you any deductions other than your real estate taxes.
Yeah, this is just another thing where the phase outs start 100,000, or for tips is 150,000. I mean, this is really geared at helping the middle class. Again, maybe more or less of a New York City area middle class, but it is geared toward the middle class, at least thus far in what we've talked about, and not just for the and not at all for those who are earning $250,000 or more.
And by the way, I suspect when they clarify the regs on this, it'll have to be for new vehicles, not used. But we don't have that clarification yet.
Okay, so senior citizen deduction, another thing that was talked about. This is another thing that we don't just have to look for, but it was actually discussed prior. So this was supposed to be Social Security benefits free from income tax. Now, already before the new law, we've already had a portion of Social Security that's free from income tax, regardless. At the most, only 80% of your Social Security income could be taxable anyway. But you can't have Social Security provisions in certain rules, and so it didn't happen exactly how they hoped it would happen. The provisions here are that you have to be 65 years or older in 2025. You need to, so there's a typo here. You need to be claiming Social Security, and the maximum deduction is $6,000, and it starts to phase out at $75,000 for single persons and $150,000 for joint filers. It's not a refundable credit. Sorry, I'll let you go ahead. You have to owe taxes in order for this to actually help you.
And, for those of us, again, who are of a different generation than that young fellow next to me on the screen, Social Security was only 50% taxable up until the 90s. And in order to keep the system solvent, they raised it from 50 to 85%. If they truly wanted to help out with Social Security, and again, you could cap it, go back to the 50%. This is going to have very little impact because many people who are under $75,000 who are single may not have their Social Security taxable Social Security is minimal.
They're already barely paying at all on it.
Exactly. So this was a good hype, but no meat on the bone, so to speak.
But listen, it's we said this discussion today, our CLE is not political, but the tax law is political. It's inherently political. You could argue that paying the least amount of taxes is a patriotic duty because our government tells you what they do, want you to do, and don't want you to do. And if you do what they want you to do, you'll pay less taxes. But for something like this that has no benefit, it almost is purely political because they get to say, hey, we helped senior citizens. But in effect, there's not going to be all that much help to be had. Before we move on, there was a question about auto loan interest deduction and if it applies to leases. It does not. The new rules, the itemized deduction is just on the purchase of and interest on new vehicle purchases. So,
matter of fact, I think at this point it might be helpful if you have the materials available to take a look at the bottom of page 1 of the new return of the proposed return, where it's you actually on the on Schedule 1, which is the third page, and see, excuse me, all the additional income on page 1 and the adjustments to income on page 2. Here's where we, after line 20, 21, we get to new things at the bottom under line 24, jury duty, that's going to be excludable. Reforestation, I love that. I once made a joke about riparian rights to the then chief judge of the third department, who gave me a look that could kill. We do have riparian rights cases in the third department, she told me. Other pension plans, attorney fees.
So this H. So if you are looking at the material, and I'll read it out loud. 24H, attorney fees and court costs for actions involving certain unlawful discrimination claims. Okay, so this wasn't even part of our material, but only because we're looking at it, I'll bring it up. I work with a couple of employment law firms on the side to do consulting on their employment settlements. I will consult on how the settlement should be written, and then oftentimes I'll prepare their tax return for the plaintiff in those cases. In almost every case that I've done, there will be some type of audit whenever we have a reduction of income due to attorney's fees paid, because attorney's fees, unlike pre-2018, attorney's fees are not deductible except for certain cases. And so we would inevitably, I would tell the client, expect to have an audit. We would have that audit. I'd have to then provide the Internal Revenue Code statute to the auditor and hope that they understood it. This hopefully will make things easier for those cases. So if you do employment law, or if you work with employment lawyers, hopefully this will make things easier, because it'll be very clear. You don't have to put a note in. It'll be very clear as to why there is an adjustment to income. So this is something that is helpful.
By definition, all employment claims are discrimination claims under the IRS code. So that's helpful. The other part, I like the 24I now is the rat rule. You drop a dime, although there's no more payphones, I guess you can't drop a dime anymore on someone, and you have an attorney representing you. We have one of the neighbors in our New York City office is qui tam, does these kind of claims, whistleblower, and his fees would be deductible to his client on any recovery that has to do with the IRS. Notice it's only the IRS. It's not Medicare, Medicaid, or any of the other areas where people will turn somebody in because they don't like them or they want to make some money. Right. Moving right along, Airbnb. Interesting enough, this one starts as of Inauguration Day. So we can certainly give credit where credit may be due. For those of you who, most of us do real estate, that's why we're here at the title company's CLE. And real estate became passive as of 1986 tax law. And what it meant was if you made over $150,000, you could only write off your losses against other passive income. Between $100,000 and $125,000, your client could phase out any losses they had. 2 for 1, every $2 you earned over $100, you lost $1 of deductions, and the maximum deduction was $25,000, unless you were truly a dealer in real estate. Depreciation was limited to 27 and a half years for residential and 39 years for commercial properties. And the question became, what about the property itself? Well, you were stuck with that. Improvements for many years had the same life as the property. Now, you can 179, you can take a full deduction, depreciation deduction, for various eligible purchases that you couldn't before. You had to depreciate furniture and fixtures. Now you can write it off. Certain renovations, appliances, equipment. And the key is, does it have a life of 20 years or less under the depreciation rules? The IRS has a publication on depreciation. It has lives for everything from pigs to nuclear plants in there. So you can find the information there.
They have already had clients who believe that they can take 100% bonus depreciation on the actual property itself. They're buying a place upstate. They have this great place in Greene County. They're going to write it off because they have this other commercial place in Jersey. They're wrong. And it's important that that is clear to clients who are discussing these purchases. Of course, it kind of goes against our personal interest because we want another closing, but you are going to have people who hear that you could now deduct 100%, and they're going to go for it, especially because they think they could also get to write off the full amount because that would obviously be a large loss that year. But it really only applies to things that are 20 years or less, which houses are not 20 years or less. So it's important that you, because this is probably one of the more practical impacts, not just for your personal life as just attorneys and people who pay taxes in the United States, but for clients to be asking about.
And the non-business use, we have a number of clients who have a ski house or a house in the mountains or a house down here in Florida or whatever, where they rent it out. The non-business use of the property is not eligible. If you're in your place, and a lot of people will spend 2 weeks in their future retirement home because you want to do at least that. But if you have people who were there less than 2 weeks total for the year, it doesn't matter one person or multiple people, you're not declaring that income on schedule. You get 14 days, basically. After that, you have to report it. It's subject to all the depreciation rules. You have to report the business use percentage. And one of the arguments I've had on audits over the years of this section had to do with what's the rentable period. Is it 365? Or is it the season, so to speak? And here, down in Florida, where I am now, in West Palm Beach, the season theoretically and traditionally is November 1st through April 30th. So you're talking about a 183-day window, 180-day window, and figure your percentage on that. The people who have ski houses, if there's no snow, maybe their season's only 4 months. And that's what we have clients in Vermont who claim that's the answer. And that's going to affect this write-off. You're not going to get the rest of the year, I believe. The regs, again, are not out. But if you put in a new roof, a new heating system, central air, which might have less than 20-year life, it's going to matter what your business use percentage is and what it's based on. Daycare has their own rules, and that's based on hours. That's just another interesting aside. Oh.
All right, moving on to more changes. This time about 529 plans. So these are college saving plans. So we don't have anything in the materials here because like everything, the regs are still coming. But this also coincides with the Trump child accounts. They're separate from one another, but they are related because they have to do with kids. So starting this past July 4th, there are additional qualifying expenses for college saving plans. So this is more not about putting money in, but taking money out. You can deduct what's a qualifying expense. So what is not included in income for what would otherwise be an early distribution: curriculum and instruction materials, online education resources, qualified tutoring. Now the tutoring does have quite a bit of restrictions as to what counts and what qualifies, but the fact that you can write off tutoring at all is new. Now, one thing to keep in mind for any K through 12 costs, if you are a New York resident, or if you have clients who you're offering advice to their New York residents, is when the federal government allowed private school K through 12 to be qualified for 529 disbursements, New York State did not. That is another instance where New York State did not match the feds. So you will be taxed and potentially penalized for distributions that you take to pay for non-higher education in New York. But these rules are federal rules, and other states would have other rules involved as well. For the Trump, I think this is the actual name, the Trump child accounts. So these seem like there's no income restriction at this point. It seems like for parents. The accounts you have to, I think, again, we're learning here, apply for the account to be open, but once it is, you have a government funding of $1,000, and then you can put up to $5,000 in per year, and it grows tax-free like a Roth IRA, like a 529, and can be used for certain expenses, just like a 529, but also including first home purchases, all this stuff. So the child accounts are only for children born after January 1st, 2025. And as of right now, it expires also December 31st, 2028. So if you're pregnant, you get pregnant at the beginning of 2028, try to have that baby before the new year, both for the tax child credit and also for the Trump account.
As a parent and a grandparent, I stopped putting 529 money in for my grandchildren. I buy them stock on their birthday every year. But I could do something like this. I'm not getting a deduction anyway. So if I'm concerned with their future instead of their spendthrift father, I might form these for any new grandkids I have. Unfortunately, Liberty and Ulysses are out of luck.
The way it goes.
Okay.
Now to the meat. Yeah, no pun intended for the salt and the meat. This is what people care about for themselves personally. It's relevant to clients who are purchasing in high property tax areas. We have the increase of the SALT limitation from $10,000 of property tax to $40,000. And it's not just property tax, it's also state and local income tax.
And personal property taxes.
And personal property tax, of which there's less locally. So, sounds good. The thing is, it doesn't apply to everybody forever. So this was one of the major issues that raised people's ire in New York, Republicans, Democrats alike, when the law was changed and people could not write off their property. It was really a property tax issue that people focused on. But of course, if you're a high earner, you have a lot of state and local, for New York City residents, income tax. It was a big factor. I never had as big of an issue with it as others because, as we mentioned in here, of what the alternative minimum tax consequences were to the deduction of your property tax and the like. We are not really sure exactly how this will still work in effect, but we may have an issue where the AMT will be back in a big way. The deductions, like most of these items, do have a phase out, and that phase out begins at $500,000 for a married couple and $250,000 for single and separate filers. And there's a 30% reduction of the excess over the threshold. So what does that mean in layman's terms? If your income is $750,000, then you're $250,000 over the $500,000 phase out start. 30% of that is $75,000, so you're back to the $10,000 number. Even more simple. For every dollar that you have of income above $500,000, you lose 30 cents of the extra $30,000 benefit. So if you make $600,000 on the dot, you've lost the full $30,000 deduction benefit.
I've been modeling these for a couple of clients already. And it's easy. It's an easy fit, an easy answer. If they're over 600,000, I say, hey, doesn't matter. But between 450 and 500, depending on your other alternative minimum tax items, you might see AMT coming back. I mean, the big issues for AMT, especially for those of us in New York, we pay a large amount of taxes. Oops, actually, I'm not in New York anymore. I'm a Florida domiciliary, so I don't have that income tax. Thank you very much. You'd have a combination of employee business expenses and state and local taxes that would kick you into the AMT. We'd have two police officers making $100,000 each, and they would be subject to AMT because there was an add back for both the taxes and the employee business expenses. That's not coming back. That's not deductible. So I think it'll have some impact when you get close to that $400,000 to $500,000 range. But I don't think it's going to be horrible other than that. And it's a welcome relief, especially if you're paying taxes in Westchester County or Putnam, Rockland, any of us who are in the Hudson Valley.
So there's a question. Sorry, go ahead.
No, you go.
There was a question in the chat right at the beginning about the question wasn't the previous SALT deductions better for us here in New York State before the reduction of SALT and now the attempt to restore it partially? Should we not ask our elected to go back to the original SALT tax laws? I mean, the answer is yeah. Ask your elected to do anything that you can ask them to do. It's doing it that's hard, but absolutely the old again AMT under the old rules did void a lot of the benefit, but yes, no limitation is definitely better than any limitation. And so here, whether it's the income limitation or the $40,000 limitation, yeah, it was preferable and better previously. And I am a big fan of writing to my elected officials.
Okay, estate and gift news. Okay, for those of us who've done some estate work, and you had an exempt estate federally and a taxable estate for New York, you would want to file a tax return, especially if there were assets that had appreciated in your client's estate, to lock in the step-up basis. Okay, step-up basis briefly is you buy something at a certain rate, you die. The cost to your heirs for capital gains purposes is the date of death value, or alternately 6 months later value. Many years ago, the IRS was rejecting returns that were filed for the purpose of establishing that cost basis. They didn't want to be bothered with the paperwork. Then along came portability. And portability means that your exemption, your exclusion from federal estate tax can pass to your spouse. So, right now, the exclusion is $19 million. Yes, if it isn't in an irrevocable trust, yes, thank you. I saw that question just popped up. My client has that taxable estate. He just got remarried. At the moment, he has a $19 million exclusion, plus his previously deceased spouse unused exclusion. You only get one. If this second wife predeceases him, he'll get her unused exclusion, if any. But in order to get the portability, the additional exclusion for the surviving spouse, you must file a return. So now IRS has to accept an estate tax return even where there's no tax. You don't file, you're not entitled to the exclusion. Okay? New York State has a much lower exempt amount, 7.16 mil. It is phased out at 5%. Around 7.51 now. And after that, you lose the exclusion completely. It's like falling off a cliff is the way it's described in most of the writings. And so, you can build for this. Make sure your client's aware of it if you're preparing a will or doing any estate plan. And it's a good thing to have and know what to do with. I'm going to take the next section because I've done this, unfortunately.
All right.
I had a client.
Move on. I just want to pop in really quick and give the code word for today's CLE. The code word is SALT. The code word is SALT. Okay.
The next section of the materials we provide has to do with death from terrorism and astronauts, actually. I had a client who was a firefighter in Westchester County. He goes down to the Trade Center as a volunteer, as many did. And about 5 years ago, he's diagnosed with pancreatic cancer, stage 4. Mount Sinai certifies it as connected to his exposure to toxins at the time of the Trade Center cleanup, where he was. And his disability, I know him, certainly I knew what was going on, and his disability lawyer and I spoke to each other about getting him the tax exclusion. Okay, so what is it? You get 3 years of taxes back for his heirs. He has to have died in a related causal relation, disease or disability or injury. And I will tell you, it was hell getting final approval from the IRS for this. I was very fortunate. The last revenue officer that I had, revenue agent that I had involved with this, was from Long Island, and he knew people who lost their lives from this. And he spent 3 hours on the phone with me, making little alterations to the application to finally get this through. And basically, the surviving spouse ended up getting about $200,000 back with interest from the government. New York State, same 3-year rule, but a much lower cap of $20,000 per year. It's sad, and we will still see these people are still getting sick from 9/11. I love the part about astronauts. Somebody must have had a good lobby for that. And this also came up in the 2001 Act on the Death from Terrorism. Okay, our last little section has to do with inflation adjustments for this year. Just so you know.
Yeah, let me skip that because I said we can skip that because that's just the numbers kind of speak for themselves. I know that we're running low before we start doing questions. I just want to talk about gambling real quick.
That's right.
So gambling is everywhere now. You can't watch sports without either seeing gambling ads or seeing a guy run out of bounds when it makes no sense and thinking maybe he's been paid off by the gambler. So what's the change? The change is it is as of the last year, you can write off 100% of your gambling losses against gambling wins. So if you won $100,000 and you lost $100,000, they would cancel out. The new rule is you can only write off up to 90% of your losses against wins. So in that same scenario, you made $100,000 and you lost $100,000, you still have $10,000 of income because you're only able to write off 90% of that $100,000 in losses. If you made $110,000 of losses and $100,000 of wins, you're going to pay on $1,000 because the 90% of $110,000 is just $99,000.
And I believe this is still an itemized deduction only, Scott?
Yes, correct. Which already in 2018 changed how things work because if you weren't itemizing, you still were paying on quite a bit of your wins, even if you had offsetting losses. So I just wanted to, just to throw
and one
in
of the outs is if your client is a heavy gambler or a professional gambler, you might want to have them file on Schedule C to zero out that other 10%.
All right, so we do have some questions in here, and feel free if you have other questions to type them in now to the Q&A or even to the webinar chat. A question from Mark was, for NYC single taxpayer with lots of state income and local income tax and real estate taxes, when does SALT phase out? It also, for single payers, it also starts to phase out at $500,000. So you have that $500,000 of income is you're fully eligible, and then it starts to phase out at that 30% rate after the $500,000.
Right. In other words, the marriage penalty is back.
Yes, on that, yes.
Okay.
There's a question on, and I'm not sure the answer. Maybe Dad, do you have 5 years from date of death to file return for portability if no estate tax is otherwise due?
Well, since no estate tax is due and you're not claiming a refund, generally you only have 3 years to claim a refund on any tax return. I see no reason why you can't wait. And frankly, in some cases you don't get letters for 3 years in some places. Try Kings County. You're at the mercy of the clerk. That's all I can say about that. But yeah, there shouldn't be any problem with that. But the sooner you do it, the easier it is to track the actual valuation. Common stock and bonds are easy. There's a market for them. Real estate, collectibles, you might want to do it then, stay within that 6-month window because you may not be able to get a fair appraisal on the art and the real estate and other collectibles going forward 5 years out. So.
In gambling, can you deduct a loss incurred in 2023 against gains in 2025? No, as far as I know, it has to be the same year. Everything's all within the same tax year. So if you had old losses, should have done it the opposite. Good job on getting better at gambling.
And it's not subject to net operating losses unless, again, I have people who do it as a Schedule C business. I had guys who were playing online poker, making millions of dollars a year, make $3 million 1 year as a Schedule C, as a self-employed person, and have 200,000 in losses the next year. That carries forward to year 3. Back there, actually, then you could carry it back 3 years. Now, all NOLs only go forward. Hi, Diana.
Hi. This isn't the hook. I'm not kicking you off. I just popped in towards the end.
So yeah, I mean, if you have any other questions, feel free to ask. Otherwise, the inflation and the increase in rates are all in the materials. We would otherwise just be reading off those numbers. But I think happy to hang out here for the next 5 minutes or longer if anybody does want to stick around and ask anything.
Also, you can find us on Facebook, Ring and Ring, PLLC, and ask us a question. We'll probably answer you.
Well, you guys made my job easy. I didn't have to, you guys kept track of all the Q&As for me. So I think we don't have any other open questions. You guys answered them all. Gary and Scott, wonderful. CLE, I enjoyed it very much. I think everyone else did. It's always a pleasure. I wanted to wish everyone a very happy holiday season. We'll see you in January with a FinCEN CLE. I know everyone's going to have a lot of questions on FinCEN. So in January, we'll be back after the holidays with that. So thank you guys again. Always a pleasure.
Yes.
Have a great holiday season, everyone.
All right, please fill out the evaluations as well as your other documents. We actually read the evaluations, Scott and I.
Yeah, so I will send them to our speakers once I collect them all.
And we'll see you 2 years after the next tax change, because there's never a tax law change, or rarely, if ever, in an election year for Congress.
Till 2027.
Yep.
See you then. Have a good day, everyone.